And welcome to Smart Karma's corporate webinar. I'm Sanam Nanwani from Smart Karma. This week, we are hosting OUE Commercial REIT. We are glad to have with us OUE Commercial REIT CEO and Executive Director Han Kim Siew and CFO Lionel Chua. To kick things off, we will start with a brief industry overview presented by Smart Karma Insight Provider Angus McIntosh. Following that, Mr. Han will walk us through a company presentation and engage in a fireside chat with Angus. We are taking live Q&A, so I would like to request our attendees to post your questions in the Q&A tab at the bottom of your screen. During the webinar, we will also share some links on how you can connect with OUE Commercial REIT and read more research by Angus. So please do keep a lookout for messages in the chat box. And without further ado, I now hand it over to Angus to take us through the industry overview. Angus, please.
To begin with, I'm just going to give a brief overview of the Singapore commercial market, I think I'll probably start with the office market. Singapore office market, it's been pretty resilient, really, given the environment of rising rates and supply chain issues, geopolitical risks, and so on. And we're seeing still, I think, ongoing demand for high quality office. There's been a bit of a flight to quality. That sort of refers to the sort of more sustainable buildings. So more modern, sustainable green buildings are in demand. And I think coming out of the pandemic, also there's a focus on high quality work environment as well. But there's been very little new supply in the investment grade market in Singapore. I think only Guoco Midtown opening this year is the only new supply coming on. So that's helped to support rents. Capital values have been under a little bit of pressure. 2024 we'll see completions hitting a 7-year high. So you've got 3 major projects coming online in 2024, early 2025, including IOI Central Boulevard, which is 1.3 million square feet, Keppel South Central, which is 600,000 square feet, and Shaw Tower, which is a redevelopment, 400,000 square feet, which will probably come on at the beginning of 2025. But that's 1.5 million square feet still left uncommitted. So there's a bit of oversupply potentially, or supply overhang for the market going into next year. So there may be some downward pressure on office rents in 2024, but I think high quality buildings will remain pretty resilient in that environment. Here's the rental value indexes from JLL and the capital value index. You can see that they're expecting a slight downturn in rents, not massive downturn, but a slight downturn in rents, as well as capital values over the next year or so. And here you have the new supply coming on the tail end of 2024. Looking at the retail market, it's a much happier picture. There's been a very strong post-pandemic recovery, driven both by domestic demand, people back to work, workforce on the streets, so more footfall, a recovery in tourism. So tourist arrivals will hit 10.1 million in the 9 months of 2023. And now that's still it's about 70% of pre-pandemic levels. So there still is upside to tourism arrivals. New occupier demand comes mainly from new to market brands, existing brands building more physical stores, having been online for a long time. Also areas of strong demand, F&B, obviously people getting out and about, athletic leisure, apparel, and luxury retail all doing relatively well. And I think, there's still a relatively tight supply situation. So vacancy rates have continued to fall. There's been one closure of J-Cube over the last year or so, or this year. And there's a lot of rejuvenation has been going on and redevelopment. Tourism obviously driving occupier demand, and the other factors which I've already mentioned, including a tight labour market. So, wages remain quite firm, more conferences, more exhibitions, all helping to increase the footfall into malls and so on, and keeping occupancies quite high. And so the outlook for rentals and capital values for retail, I think, are still relatively positive. Here's a chart as well showing that from JLL again, looking at rental values and capital values moving up slightly over the next year or so. And you see some new supply coming on not until the tail end of 2024. So a relatively healthy picture there for retail. Hotels equally, I mean, a very strong recovery, mainly driven, I think, from tourists coming from the region, so India, Indonesia, and a recovery in Chinese arrivals as well. RevPARs have increased, really very strongly over the last year. Third quarter, they're up 64% to 381. But that's there's even a stronger rise in average daily rates, which are now at $501. Tourism arrivals are expected, they're 70% of pre-pandemic, they're expected to reach 12 to 14 million in 2024. So there's still quite a lot of upside from that, which should help to underpin, quite strong demand for hotel rooms. New hotel room supply is actually quite high. I mean, 3,274 new rooms 9 months in 2023, mainly from refurbishment and some delayed projects coming online. And I've mentioned 4 hotels here: Peninsula Excelsior Singapore, A Wyndham Hotel, Coma Metropolitan Singapore, and A Loft Singapore Novena, all of which are quite sort of luxury end of the market. So luxury is about 50% of new supply. There's about 5,500 new rooms to come on between fourth quarter and 2025. So there's quite a lot of new supply coming online, and again, about half of that in the luxury segment. Occupancy rates are quite high. They're still slightly below pre-pandemic levels, but 76.1%. RevPAR 23% above pre-pandemic already. The average daily rates at 501 are also 25% above pre-pandemic levels. So full recovery expected next year, but potentially more competition, which could put pressure on room rates potentially. So that's my overview. I am now going to stop sharing my screen and hand over to Mr. Han, who's going to talk to you about OUE Commercial REIT. Mr. Han, over to you.
Thanks, Angus. Wonderful overview there. So what I'll do is I'll run through the presentation fairly quickly in 10 minutes, and then we can move to the Q&A and chat with you as well, and take any questions we have from the attendees. So, okay, very briefly, we have 6 billion AUM with 7 high-quality assets, and there are over 1,600 upper upscale hotel rooms. Our commercial assets, in terms of size, net lettable area of more than 2.2 million square feet. So the key theme in this in our portfolio is the prime core location of all our assets. Okay. So what have we been doing since listing in 2014? So between 2014 to 2019, the focus was on growing the REIT. So two assets, Bayfront and Lippo Plaza, were the seed assets. 2015, One Raffles Place was added, and then in 2018 acquired OUE Downtown Office, and then there's a merger with OUE Hospitality REIT, which brought on the Old Mandarin Orchard Singapore, the Mandarin Gallery, and also the Crowne Plaza Changi Airport. Now, we were with the enlarged scale. It was important to grow the scale of the REIT. Now we have economies of scale. With the growth, with the enlarged REIT, we're able to do achieve three things. One, we were able to undergo a $150 million asset enhancement program and rebrand the Old Mandarin Orchard Singapore to the new Hilton Singapore Orchard. We were then able to also divest 50% of Bayfront at a 7.3% premium. We used the majority of that debt to pare down our debt, so bring our leverage levels to a more comfortable level of below 40%. With the enlarged REIT, we were then included in the FTSE EPRA Nareit Global Developed Index, thereby increasing our trading volume and trading liquidity. Brought on board a lot more institutional investors from there. In 2021, we obtained our first sustainability-linked loan. In 2022, we opened one tower of the Hilton Singapore Orchard on 24th of February. In May, we issued the Singapore's first bond with a coupon step-down mechanism, where once we achieve an investment grade rating, we then enjoy a savings of 25 basis points. So it was a $150 million bond for a 5-year term issued last year. So This year, in October this year, we achieved a BBB- investment grade rating from Standard & Poor's S&P, and that has allowed us to save 375,000 per annum going forwards for the remaining tenor of the bond. We also obtained the largest sustainability-linked loan for Singapore REITs in August this year. We refinanced a substantial portion of this year and the following year's debt as well. So it was 978 million, very well subscribed, 1.26 times oversubscribed. So what have we done in 2023? So we opened the second wing of 446 rooms this year. So we have full room inventory effective 1st of January this year for the Hilton Singapore Orchard. Then in second quarter of this year, we refinanced an existing borrowing of 430 million. We've now increased our sustainability-linked loans to just under 70% of total debt, which is one of the highest among all Singapore REITs. In third quarter, since we had completed the Hilton Singapore Orchard asset enhancement initiative, we announced a $22 million asset enhancement initiative for the Crowne Plaza in August, and we expect it to complete by December this year. So just in time for 2024, which is a big event here for Singapore next year. I'll come to that a little bit later. In fourth quarter of this year, we obtained a 3-star GRESB assessment rating improvement from last year. We were assigned the investment grade rating by S&P 30th of October this year. 7th of November, we established a green finance framework where Fitch has rated it a good rating on the framework, which is equivalent to HDB, what HDB in Singapore has. So that allows us to basically going forwards, move forwards with issuing green bonds and undertaking green loans as well. So well set up for next year. Key investment merits. So there are 5 key areas that I'd like to focus on. Number 1 is the quality portfolio of our prime locations. Okay, so by asset value and by revenue, there's no single asset which is overly sort of dominant, so fairly well weighted. The largest contributor by revenue is the Hilton Singapore Orchard at 28%. On the far right, we have a revenue by segment division. So we have a barbell strategy going on here. So where circa 48% of our income comes from the office in Singapore. It is 3-year leases typically, so it provides stable income. The retail and hospitality segment with the improved visitor arrival numbers this year, going forward to next year. So last year we had circa 6.3 million visitor arrivals. This year to date, October, we're at 11.3 million. Next year, we hope it will be higher than this year. We do expect it to be higher than this year. In 2019, the visitor arrival numbers was 19 million. So we're still short of the 2019 number. So there's a lot of upside for the retail and hospitality segment, we believe. So we saw in the third quarter of this year very strong growth. Revenue improved by 27.5%. Net property income also jumped to just under 30% year-on-year growth. So it was actually, sort of fairly well balanced. It wasn't just hospitality driving it. Hospitality contributed to a large part of it, especially from the Hilton Singapore Orchard. But our Singapore office has been very resilient as well. Committed occupancy of just under 96%, and we reported a 18.4% positive rental reversion. Now, Mandarin Gallery, our occupancy is just under 99%, and we recorded for the third quarter of this year 31% rental reversion on the back of tourist arrivals and improving retail sales. So our retail tenants had more confidence, with their outlook in 2024 and 2025. Okay. So we carried out a very large asset enhancement initiative starting March 2020. We opened our first wing in February 2022. So we refurbished all 1,080 rooms. We've converted the event space. So we have the largest MICE facility on Orchard Road at this point in time, circa sort of 2,300 square meters. Now, these are all configured for hybrid conferences. Yeah, so it's sort of modern and really what going forward is what we feel MICE participants will want as well. So proper breakout, multiple breakout areas as well, where you can have smaller events, larger events, mid-sized events. So really very much future-proofed for the next, I would say, 5-10 years, really. Okay. What we're doing for the Crowne Plaza, we are adding on 12 more rooms by the pool. The pool rooms, the rooms facing the pool side, we have found to be really popular with staycationers and also with transit guests as well who've been on long flights. They like to sit by the pool and get some fresh air as well. So it's we've decided to add 12 more rooms there. We're revamping our all-day dining. We're bringing in a buffet Italian buffet spread. So it's North and South Italian cuisine. And our pizza oven will be sort of the main piece of our all-day dining that's been installed at this point in time. So we should be up and running by December. We expect a stabilized return of circa 10%, and the asset enhancement initiative will be DPU accretive. Okay. On capital management, we feel we've been very prudent, and we've been very sort of far-sighted in terms of our planning as well. So last year, when the Fed was starting to talk about Fed hikes, we very quickly issued a bond in May. Our target was before the May FOMC meeting. So because we felt the Fed was going to push it up, so we came out with a $150 million 5-year note. And we felt there was potentially a refinancing risk going forward. So we undertook a lot of the 2022, 23, and 24 refinancing and combined it. And it was a $978 million refinancing we did last year. So with the completion of the remaining $430 million refinancing that we undertook and completed in the first half of this year, there's no more refinancing due for the whole of 2024. It's only starting in the middle of 2025 onwards, second half of 2025 onwards, where we do have to refinance our our existing financing facilities. So a good runway, if the market and the economy does turn south, where we're very well positioned for that. Our aggregate leverage is currently 39%, so comfortably below 40%. Our weighted average cost of debt has nudged up, as experienced by most businesses. But our average term of debt is just under 3 years, so very comfortable. We have hedged our debt as well, so 68% of it is fixed interest rates. So we do sort of experience a bit of pain with the interest rates being higher, but circa 32% is really where the pain is. But the bulk of it is hedged. Amount of unsecured debt, we moved away from having a lot of secured to higher percentage of unsecured debt. So that allows us to, going forwards, reduce our cost of debt as well. And that was one of the key factors allowing us to achieve a investment grade rating from S&P. Our interest coverage ratio, you'll see has improved from 2.4 to 2.5 quarter on quarter. Now that is a function of our improving revenue from our offices and also from the hospitality assets. So things are looking good. We're cognizant that we have 2 high debt maturity walls in 2025, 2026. So we'll be proactively doing some early refinancing to smooth that out. Okay, the team is I would say fairly new. I joined in February last year. Most of the team joined in 2022. Lionel actually joined just around the time of the merger, so he's been here the longest. But it's a new team, as you can see. A very well balanced, diversity as well within the team. So allows various views and obviously come up with a much better solution when we bounce ideas with each other. Okay. Now sustainability is a big part of of any business going forward. So just to highlight a few of the things that we've been doing on the sustainability front. GRESB, we have a 3-star rating. 96% of our portfolio are green certified. So that's one of the highest among all Singapore REITs. Okay, 70%, circa 69% of our borrowings are sustainability linked loans, and we started introducing green leases in 2021. You'll see this 21% number start ticking up as leases are being renewed. The S part is important. 50% of senior management are women. 73% of our employees are women as well. Tenant satisfaction is at 89%. So, we are working on improving that as well. Employees, we have a high overall satisfaction score of 91%. So with regards to governance, for the SGTI index, we've improved to 26. So from 28 last year, scores have also gone up. So that's a area we focus on. MSCI ESG rating with a BBB now, and Morningstar Sustainalytics have provided us a low risk rating. Now going forward, what are we looking at? So three key areas. Number one, we like to optimize the cost of debt. Obviously, with the investment grade rating, we can come to market for bonds, and pricing will be tighter. So that will help us as well. I touched on the refinancing requirements to smoothen out our debt maturity profile earlier. Now, next year, with the improved tourism recovery, we believe our hospitality and retail assets will remain strong. Singapore, there's very little office supply. The CBD Grade A office occupancy is 96%. There's very little supply coming forwards until 2030. The government is not releasing any more land for government land sales. So there is very limited supply. Inquiries are still, I would say, still fairly strong. And we believe limited supply, Singapore being a key sort of destination with the outflow of multinationals from out of Hong Kong, etc. So going into Tokyo, Seoul, Singapore is an obvious destination as well. We're proactively managing lease expiries as well. So going forwards, and we've started regearing the leases for a number of our assets for the first and second quarter of next year already. Operational expenditure. 1st of January this year, we implemented a service charge increase across all our Singapore commercial properties. So that will help buffer some of that inflationary impact. But I can say actually in Singapore, the inflationary impact, that sort of sharp spike has really slowed. We've seen utility rates come down as well. We've locked in this year. We've locked in fairly low rates as well, starting second half of the year. So below spot rates, a fair bit below spot rates. So green building certifications are important. We're working on that. So that will allow tenants confidence that we are keen and we are focused on ESG. In the near term, what are we looking at? Cost of debt is circa 5% fresh funds, I would say. So acquisitions will be challenging to be yield accretive. So we're very much focused on asset enhancement initiatives. So a hotel for the Hilton Singapore Orchard, because it was such a massive undertaking, it would actually take 3 years to stabilize the performance. So last year was the first year because we opened one tower. This year is the second year we opened the second tower. Next year is when we'll really stabilize the hotel. And sort of for 2025 onwards is when we'll see peak performance coming through from the Hilton Singapore Orchard. Similar story for the Crowne Plaza as well. It's slightly smaller asset enhancement. It'll take us at least a year to stabilize that. So 2025 onwards, it should look a lot better. For the longer term, we are focused on hotels as sort of one of the key focus, offices, mixed use, meaning hotel, office with maybe some retail component as well, in prime CBD areas. So we're very much focused on prime CBD locations. So Singapore's a geography which we are keen on. Similarly, key gateway cities in Japan, Australia, and for the UK, it'll be London. So that's really our focus. But that's more sort of medium and longer term.
Great. Well, thank you very much for that. It's very, very concise and very good to hear all the sustainability action that you're taking. and it looks like you've managed to jump the gun on refinancing ahead of rate rises, which is very, very well timed. Can you hear me all right?
Yes, yes.
Yeah, good. No, just checking that before we start off. Yeah, I mean, I might just start off with questions around the office market, because obviously you've seen very, very strong rental reversions coming through in 2023. What does the rental reversion cycle look like, going forward? Because this is probably still part of the post-COVID recovery, I would imagine. So what kind of annual reversion rate would be a kind of normalized level, would you say, for office? To give the attendees a bit more idea of the timing of the reversions, how much of the portfolio comes up for reversion each year?
Okay. So, 3-year leases means it would be circa sort of a third, roughly a third. Obviously, you would have some tenants which are locked in slightly longer, 5-year leases. So that skews it a little bit. So I would say just under a third of the portfolio comes up for renewal every year. That's sort of typical. Obviously, leases expiring in 2024, these were signed in 2021. So during COVID, these were much lower. Current sort of spot rents are 11.85 for grade A CBD offices. Now, our average expiring rents for next year are 10.31. So I think next year rents will probably be flat. So it would range. It depends on really where the sort of economic outlook lands next year. I think it would probably be sort of a decline in spot rents of maybe mid-single digits all the way up to a low single-digit rental growth, right? So it really depends on what the Fed does, what the global economy outlook looks like, what Singapore. So I would say that's probably the range. Now, if we take worst case scenario, 5%, right? Mid-single digit decline. Well, 11.85, if you take off 5%, it's still comfortably above our 10.31 average expiring rents. So we still expect next year to be enjoying, I would say, single-digit rental reversions for our Singapore office portfolio. So that'll be very comfortable for Singapore. So yeah, I mean, I think if you look across the Singapore, again, I'm talking specifically about the grade A office buildings, right? Because if you look at, you obviously have the work from home, and you're concerned about the work from home, but we own the One Raffles Place, a retail mall, so we track footfall, and footfall there is circa 90-95% of pre-COVID levels. So which means people are back at work 4.5 days a week. So essentially, people are back at work. Now in Singapore, a lot of that right sizing for hybrid working actually occurred during 2020, 2021. But what a lot of tenants are now finding out is most employees come back to work Tuesday, Wednesday, Thursdays, and they had planned for 60-80% of the staff to be back at work. So what that means is everyone jams and comes in at Tuesday, Wednesday, Thursday. Well, people don't actually get a seat on those days. So now they're trying to right size it again. So the concern about right sizing for work from home, I think there is no concern about that because that had all occurred back in 2020, 2021, I would say.
Right. So your kind of hybrid working environment has kind of already established itself in a way, and now they have to kind of readdress it because they've probably gone a little bit too far, or
yes.
changed. And sort of co-working, has that become a particularly sort of big impactful area?
It is. I think co-working is here to stay. It will form a bigger part of the work environment than it was pre-COVID, I would say. But I don't think it'll sort of take over from normal traditional offices as well, because there are privacy concerns, etc. Right? So all the banks and even the non-bank financial institutions, they are regulated by MAS, and they are there are sort of security checks that need to be put in place, etc. So co-working can work for certain situations, maybe the front office, etc. But a lot of it has to be secured, right? The data. So So the requirement to have your own physical office will still be there.
Yeah, no, I can completely see that. And has the, I mean, look, you've got quite a well diversified tenant mix, and and that changes, I think, constantly. Obviously, have there been any sort of major swings in terms of industries who are kind of filling up industries which are seeing more co-working? I mean, how's that balance been struck in office?
No, I would say, I mean, we have sort of circa sort of 4% tech tenants, and it has remained constant for the last 18 months.
Yeah.
Banks have not really given up space either. They're about there as well. It has been, I would say, it has been fairly stable. We have a good mix of consultancies, manufacturing, shipping, real estate. So the professional advisory sector as well has been there. So it's more sort of, I would say last year was maybe a bit more family offices, and multinational companies is trying to establish a headquarters and deciding, is it Seoul, Tokyo, Singapore, because the government had done a wonderful job and opened up early and and provided the right operating protocols. So a number of them in 2022 actually chose Singapore, right? Family offices, back in 2020, MAS issued 400 licenses. In 21, that number was 700. In 2022, it was 1,100. So all these family offices need a roof over the offices. So that demand obviously has grown.
Right, interesting. And you I mean, the shift out of Hong Kong is obviously is an interesting trend, and I mean, I imagine that Singapore has probably received quite a reasonably high portion of that, and that would be what kind of industries? That would be mainly financial services or a real mixture?
Across the board, really. I'd say across the board. Yeah. So no real one specific, but I mean, obviously you've seen a lot of the funds have actually relocated. The North American funds and the European funds are relocating out of Hong Kong into Singapore because of the Data Privacy Act, which they're concerned about in Hong Kong. So they've relocated. I mean, it's in the press. You can look at all the various names that have moved into Singapore now. That will enhance Singapore's position as a funds management, funds business center as well, because you now have critical mass in Singapore.
Right. And do you have any, before we move on to the other segments, do you have any sort of asset enhancement initiatives for the office space which you'd like to talk about, or the buildings in
No, buildings are pretty good. What we like to do is get through our sort of work on one at a time, because these are fairly large undertakings. So we'll try and complete our Crowne Plaza Changi Airport hotel as enhancement, and then we'll look at what else we can then undertake as well.
Right. I mean, it sounds like your buildings already are quite sort of sustainability friendly already, given the numbers you talk. Very good. Well, should we move on and talk about? I mean, hospitality has sort of been driving both, obviously, hotels as well as retail, and it sounds to me that tourism still has quite a long way to go. So potentially there's still quite a lot of upside, from a room rate perspective, and although there seem to be quite a lot of new hotel rooms coming on, but maybe that's not really very many in the greater scheme of things. What would you say about the hotel market?
No, I mean, if you look at the CAGR for hotel room supply, it is circa sort of 2.6% between 2023 to 2025. Now, in the 2014 to 2019 period, that number was sort of 4.3%. So we're trending, I would say, so maybe 60% of what it was actually pre-COVID. In terms of room supplies, so not really that significant. And you have to understand that, look, we're at 11.3 million for October. We may end up probably 13 million for the year, so still sort of 2/3 of that 19 million visitor arrival numbers in 2019. So yes, there is There's some sort of additional room supply, but well, visitor arrivals are picking up probably in the order of 40% growth next year if we're back to 2019 from this year.
So I mean, it looks very much like there will be continuing sort of upward pressure on room rates with that kind of growth coming in. I mean, is there a lack of luxury hotel? I mean, luxury seems to be where a lot of the new hotel supply is coming. Is that where there's a sort of a gap in the market, if you like, or where there's tight supply?
No, I think this sort of these few months, most of them opening up are around the Orchard area. So that, hence the sort of luxury type hotels you're talking about. But I would say sort of across the board, it's, there have been sort of various type of hotels opening as well. So 3-star, 4-star, 5-star. So it's, there's a push to open by 2024 because obviously it's the events are chock-a-block in the first half of next year. In January, we have Art Singapore coming through, estimated 40,000 delegates. February, there's a Singapore Air Show. That's an international air show, 24,000 delegates. Trade Fair Singapore in March, 20,000. Asia Pacific Maritime, 14,000 in March as well. Now, in April, we have the International Dentist Exhibition. So estimated delegates are 80,000. Okay, 80,000 people in April. So in May, we have the Rotary International Convention, 25,000 people. Communic Asia 2024, 40,000 people. Obviously, in March, we have Taylor Swift. February, we have Ed Sheeran. We have Coldplay in January as well. So it's looking quite, it's looking quite busy in the first half of next year. And then we have F1 in the second half. And
yeah. So where can accommodate 80,000 dentists? That's the question.
Well, that's a happy problem for us, Angus.
Yeah, no, absolutely. I mean, those kind of, I mean, would your sort of MICE facilities be suitable for all those, all those types of events? I mean, what would be your maximum capacity?
It'll be spread out. It'll be spread out across various locations. I mean, our largest ballroom can sit circa sort of 900 plus.
Right.
So so it also we're well set up to host large events as well.
And would your largest MICE facility, would that be at the Hilton or would it be at the Crown?
It's at the Hilton. It's at the
Hilton. Right. And I guess, you can obviously, given the number of rooms that you have there, you can accommodate, a lot of people.
Yeah. 1,080 rooms, two people a room. So
yeah,
slightly over 2,000.
Yeah. Okay, that's very interesting. So the kind of the asset enhancement for the hotels is kind of underway, and you're effectively, bedding down what you've already done. You mentioned obviously it takes for Hilton it'll take 3 years, and for Crown it'll take a year for that to work. Right. So that seems to be quite positive for that segment, for the segment.
Yes, it is. Yes, it is.
And you also mentioned that this the hotel segment might be one where you could potentially have interest in acquisitions.
Yes, I think hotels going forwards. If you look at sort of if you take a couple steps back and you look at it on a macro perspective, the middle income group in Asia will continue to grow. And once you have a roof over your head, your stomach is full, the next thing you try and do is you travel. So, we believe that, it's sort of structurally well set up for hospitality industry to grow over the next 5-10 years, really.
Yeah.
Right.
Okay. Why don't we move on? I've got a couple of questions coming in, but I think we should probably just cover the retail space before we move on to questions briefly. Because obviously that seems to me to be, very well supported, obviously, by rising tourism, more footfall, more Chinese tourists coming in, and you're quite well positioned with your assets, they're all in strong, in strategic areas for retail. What I mean, have there been any sort of major trends or changes in tenant mix which you'd highlight? I mean, they're all your properties all have very high occupancy rates, so maybe that's something you don't need to worry about too much.
Yeah, no, I mean for the Mandarin Gallery, we are street front, and the Apple Store, the Orchard Apple Store is directly right across us.
Yeah.
So that, so footfalls are very sort of, very good coming through there as well, in front of us. So what we've actually, done for the Mandarin Gallery is we try and curate it a little bit. We're not a large format mall. We're not a neighborhood mall either. So, no big supermarkets, etc., but very much curated. So in the last 2 years, we've brought in a number of high-end streetwear brands. We have MLB Korea, we have Sneaker Dunk, etc., and these are, and these have done really well as well. So we've seen that we have the Rimowa Singapore flagship store in the Mandarin Gallery. They've done really, really well as well. So, but we try and curate the mall such that it caters to retailers which are not looking to open in 10, 20 malls. They're just looking for 1 or 2 locations in Singapore. That's it. So that's really our key selling point, because it's slightly more smaller, slightly more intimate feel to it as well.
Right, and I guess that differentiates you because you can draw in people who will only go to that mall for that particular shop. So you've immediately got a captive audience. That's
correct.
Very interesting. So that's all good. I mean, what just a more general question on e-commerce. I mean, has e-commerce had a negative impact on retail in Singapore, or not? The two basically just go hand in hand.
Well, because again, I would say it's sort of one, it's going forwards, retail will be omni-channel.
Yeah.
Two, because of the way we curate our mall, well, if you're paying $800 for a pair of sneakers, you don't really buy it online. You actually come and you try it out and you make sure it fits properly, and you pick it up, because these are sort of collector items, etc., right? So whereas if you were buying tissue paper, you can do that, generically you buy it online, but stuff like that, you don't really do that online. So a lot of the retailers in our mall, obviously omni-channel, online presence is important. We're trying to help them with that as well, by revamping our website, by making it more social media friendly, etc. But what we're trying to do is we're trying to draw people in as well, because it's, buying online, personally I found, is a sort of it's a very sort of a straightforward exercise. There's no real sort of experience there, generally speaking. It's rather different when you come in, you try a new suit, you try a pair of shoes, etc., and there's the whole sort of a setting in terms of the retail store. So that provides an experience which we're trying to get shoppers in for that as well here.
Yeah, no, I mean, I think Singapore is in itself is a pretty differentiated market for retail. So people will go specifically to shop in Singapore. So it's obviously the regional malls would be more kind of utilitarian, but where your properties are very much kind of driven by people who are properly interested in shopping. So that would make sense. Before we sort of move on to some of my other questions, I might just go back to some of the questions that have come in. So the first one says, this is from Sanjeev Tigarajan. This is, what is the asset yield like for your commercial and hospitality assets?
Say the commercial assets are sort of trade between 3.5 to low 4s for cap rates. Hospitality assets are typically sort of north of 5 cap. But again, it's the cap rates are sort of what the yields trade at, obviously, because we're still coming out of COVID, especially for the hospitality assets. So it will, I think a normalized number, we'll probably see it in 2024 as opposed to this year, but that's really sort of the general numbers we're looking at.
Right, that's great. And the next question it relates to a question which I posed to you a little bit earlier, which is about the changing shape of hybrid office, work from home, how that's going to impact rentals on a 5 to 10 year view. And the second question is, hot desk is also an upcoming trend. How does UEC position itself to meet this challenge that will see key tenants renting smaller office areas? But as you've mentioned, that they're now renting bigger office areas, having already resized. But and the third part to the question, with the still high interest rate environment in the next 2 years, what is the way forward? So I think that's probably relates to refinancing and so on. But maybe the first two bits.
Okay.
Work from home and hot desk.
Again, the number I showed you was, we are 95% footfall of pre-COVID, which means people are back at work for 4.5 days. I mean, that is what the statistics are telling us. And one of the key differentiators for our REIT is all 3 office buildings we have in Singapore are prime grade A sort of locations, right? So in terms of attracting talent, we found occupiers, they prefer these sort of prime locations because when you're trying to attract younger talent, they don't want to go work in suburban offices. If you're coming to work 4 days or 3 days a week, you want to be in the center of the city, and you want to be where the action is. You want to go out for a nice meal. You want to go to the clubs. You want to go to your spin classes, yoga classes, and the best are always in the CBD. So, so it's important for these offices and these occupiers and these businesses to be located in the center. And and if you're only working, if you're doing a hybrid 3-4 days a week, there really is not much need for a hub and spoke type model, which was in place previously, where you would be closer to the suburban office and not so much the head office, but you can still go to the suburban office. If you're working from home, it's either you work from home or you come into the main office, right? So that obviously, with a potential recession coming up, my belief is employees will come into work because there's concern of job security, etc. And if the senior management don't see you, are you working or are you actually not working at home, etc. And what we've seen in the US as well, a lot of the financial institutions are asking people to come back to work. I mean, even Apple's doing the same. Even Zoom, I understand, is trying to get people back at work in the office as well. So I think the pendulum swung one way for COVID for obvious reasons, with restrictions and whatnot. But I think it's going to swing back the other way. And for businesses to grow, you need people back at work, collaborating, brainstorming, thinking of new ideas, and a lot of the internal equity that was built between the teams pre-COVID, a lot of that was used up. And we obviously in Singapore we had the Great Resignation last year, where a lot of people moved around, different jobs, etc. So you actually need to build that team culture again, and it's very difficult to do it on Zoom or on Teams calls, because you don't have the same level of interaction you do as when you're doing it physically. So businesses to grow and to thrive going forward, people need to be back at work for that.
Yeah. No, I agree. I might just ask you, Stan, if we can stop sharing the screen so we can see you.
Yes, thank you.
That'd be great. And I guess you can see me as well, but you don't need to do that. The next question is an interesting one. What is your view on URA's plan to decentralize office spaces, upcoming Punggol districts, and do you see eventual pressure on CBD rents as offices start spreading out?
So the government's been trying to decentralize. There's a CBD incentive scheme in place where if you, as a developer, if you take down an old office building, the government will give you 25% more GFA as a new development. But in that new development, at least 40% of it must be residential. So the government's trying to get people back in the CBD and create a work, live, play environment. Okay, so living closer to the city will sort of alleviate the pressures on the buses, the MRT, and the transportation system into the CBD. So having the decentralized CBD, I mean, that would also help as well. Yes, it takes time to build a CBD. I mean, that's the reality. So, it will work in the longer term, but how long it takes, no one really knows. So, currently we're very much focused on what we're looking at until 2030, and until 2030, we think with limited supply, the government coming out and saying there's no more government land sales within the CBD. So that will actually help sustain rents in Singapore.
Right, very good. There's another question here from John Eisenberg. Many thanks for the presentation discussion. Some solid tailwinds and supportive industry dynamics. Well done on proactively managing debt. You now have solid visibility on debt interest costs. What do you see as the midterm outlook for DPU?
I believe going forwards, with the growth coming through from our hospitality assets, our Singapore offices still, I would say, should enjoy slight growth, NPI growth coming through, based on the numbers we're looking at. And if then the sort of call is, when does the Fed cut and how fast does the Fed cut, would then actually have the answer for that midterm outlook. So if the Fed cuts a lot faster and a lot sharper, then obviously that outlook is brighter. If the Fed keeps it at this level for the next 18 months, then it's not as good. But compared to a lot of our peers, we are where we're very well sort of positioned.
Right. Got you. Okay. Another one from John Eisenberg here. Is there any wage pressure in the hotel space given tighter labor markets? Japanese hotels have problems staffing their properties, and quite a few are running at self-imposed capacity limits as they can't physically support 100% occupancy.
I would say last year we saw that wage pressure. This year, I would say it's eased off. Across Singapore, the labor market has, it has stabilized. Back then, they were for housekeeping staff, they were sign-on bonuses. I mean, security guards had sign-on bonuses last year. It was incredible. But that's no longer the case really this year. It's sort of it's a lot more stabilized now.
Right.
But last year, but I think last year was hotel owners were also concerned. How fast does Singapore open up? How fast then do visitors come in? What is the airlifting like as well from the various airlines? So it was quite challenging trying to staff correctly and not overstaff and not understaff. So there was a bit of that going on. But I think there's a lot more visibility, a lot more clarity this year and next year.
Right. Very good. Now I've got another question here, which is on hybrid work culture from British Shah. You mentioned that in 2020-21, the percentage of hybrid work culture has mostly been settled. However, I believe around the world now, there are increasing number of cases whereby commercial buildings are left vacant due to increasing preferences for work from home. But I think we've already probably touched on that point already. So I don't think we need to go on to that again. Do you anticipate that such a wave might eventually hit Singapore and other cities around the world? And are there any measures in place to combat this?
Okay, I think
Probably.
I think that question, Singapore is very different from other markets because the government takes a very proactive sort of approach towards managing office supply, office space. So, as I mentioned earlier, there's no more government land sales within the CBD for offices until 2030. That means there is no new supply. It's either you're taking out existing buildings, but you need to put in 40% as residential. So net effect is you're actually withdrawing office supply from the market in the CBD.
Yeah.
So either way, the limited supply, and if you do anything new, you're actually withdrawing. And once you actually start constructing, you're taking it down, you've effectively, for that 4-year period, you've withdrawn an office building off the market. Right. So very limited office supply. So very different. I mean, in other places, you see where the governments are not as focused on the planning, you would see sort of larger swings and then a higher volatility. But in Singapore, I mean, that's a plan, and that sort of volatility is a lot smoother as well in Singapore. The Singapore government I think correctly understands that cycles are here to stay because it's human nature to have cycles, but let's contain that amount of volatility.
Very interesting. Yeah, no, that's a very good point. I mean, Singapore is slightly, on its own in terms of the way things are managed. There's another sort of last question here, just saying that, do you have any insights on why the price of the REIT is weak? It's obviously that's market, and what are the cash and cash equivalents that OUE see recently now?
For cash and for the cash equivalents, I mean, our cash is circa sort of 60 million in the first half of this year. In terms of sort of facilities, we have sort of circa 300 million unutilized facilities. So there's really no pressure on financing, etc. And just to reiterate, we have no more refinancing due until second half of 2025. So very comfortably sort of positioned. 68% of our debt is hedged in terms of interest rate. So visibility going forwards is upside coming from our Singapore office, 2 hotels, no refinancing risk, interest rates fairly well managed, and we're at sort of, I would say, near the top of the cycle for interest rate cycle as well. So no additional, I would say, surprises on the sort of on the downside.
Right. Well, that's very interesting, and I think we've actually we're getting quite close to the end of time now, but it's been a fascinating conversation, and really enjoyed it and learned a lot actually along the way, and I'm sure the attendees have as well. So you've already talked quite a lot about sustainability. I was going to ask that at the end, but I think you covered quite a lot during your earlier introduction, so I don't mean to go to that. So this juncture, I'll say thank you very much, and
thanks,
been a great webinar, and very nice to meet you. I hope to see you in the flesh next time.
Yes, definitely. When you're in town, please give me a shout.
I'll be up very soon, so I'll be in
right.
touch.
We'll show you around the Hilton.
Oh, well, thank you very much. I love that. Yeah, thank you.
Right,
I'll head back to Sanam. Thanks very much. Thanks, you.
Angus.
Thank you, Angus, for some very interesting questions. And a big thanks to Mr. Han for a detailed insight into OUE Commercial, the challenges in the real estate sector, and opportunities for OUE Commercial REIT.